What's going on, guys? Welcome back to the channel. Today we're doing a quick analysis on Nvidia. So let's take a look at Nvidia. We're loading this up in the stock research tool. We are grading this company an 8 out of 10. We haven't touched this company in quite some time, but let's go through these different categories here. So what I want to do first is look at the company metrics category of my software, and this compares the 5-year averages to the trailing 12 months to see where this company has been lying and where it's heading. So what I can see here off the top, we have a decently high PE ratio that's been pretty consistent, but our EPS is up. Trailing 12 months, we're currently at 3.79, but on average, it has been 1.96. That is phenomenal. We have high ROE, sitting at 34% on our 5-year average, and we actually are up, sitting at 38.66. Profit margin is slightly higher, sitting at 32 compared to 30. So right off the top, folks, 4 categories down. I'm liking what I'm seeing with Nvidia. So, and jumping in to our revenue, we're currently at $29.54 billion. Average free cash flow is $4.6 billion, with our trailing 12 months being at 7.93, and we do pay out a small baby dividend at 0.09%. That works out to be $400 million paid. Easy peasy, we can cover that, no problem. This is what I like to see. I like to see companies that are able to pay off their dividend, no problem, and we can easily do that with Nvidia. So great, this is all phenomenal. High ROIC on the trailing 12 months and in our 5-year average, really high Altman Z-score, but our Pietrowski score is somewhat mediocre, and we want to see this number between 7 and 9, folks. That just means that they've been making a lot of improvements year over year. So 6 is pretty much in the middle. Not too bad. Jumping over to my main part of the software, which is the financial evaluations, where I was saying we're grading this at an 8 out of 10. This takes a look at the cash flow statements, the income statements, and the balance sheets, and gives us a grade based off if they're making an improvement or not. So with Nvidia, we have a high high PE ratio on average, so they're gonna get no points from us over here, as well as they've been slightly diluting us with 1.46% of shares increased over the last 5 years. We don't want to see that. We want to see shares being bought back, assuming if the share price is undervalued. That would mean that we have more ownership of this business and not less. That means they're taking away slices of the pie. That's what we want to do. So they're getting 2 points docked in this section here. However, they are doing a lot of things right. Take a look at this. Current ratio sitting above 1.5. Our ROE, as I said, is high, sitting at 34. It's higher, it's above 15%. Our EPS has massive growth over the last 5 years. Our debt to equity is below 50%, sitting at 43.92. That means they are building and leveraging their capital through equity and not through debt. These are all great things to see. Look at all this green across the board. The trifecta is here. Net income is up. Our free cash flow is up. Revenue growth is up, and a very, very high return on invested capital. Let's take a quick look at our income statement. We'll go to the annual basis just to see what this revenue has been looking like. I mean, look, folks, go back to 2013, and we're at $4.28 billion. Fast forward to 2022. $26.91 billion. Look at that huge jump. They have been absolutely crushing it, and this is important to see. Let's go to the free cash flow statement on an annual basis. $640 million in 2013, and it's been climbing. $1 billion in 2016, 2.9, 3.14, and 4.69. Now at 8.13 at 2022, guys. Phenomenal improvements from Nvidia. So I'm liking this company a lot. And take a look at this, guys. We're currently sitting at 171.81. We hit a high of 326. Now we're at this 171 range with a low of 140. This company's stock price has come down quite a bit. So when I see something like this, I get excited, and my immediate thing is take a look at the financial valuation, seeing how much it's being graded, and it's graded pretty high. And then what I like to do is jump into the price analysis section here. And with this section here, folks, what we can do is we can actually price out what we should be paying for this company today. we can price out based off the numbers that they've given us. And that's what we're going to do on a 10-year analysis. So I'm going to fill out these boxes here. So stand by and we'll find out what the intrinsic value of Nvidia is. So folks, before we jump into the last section of the video, if you're liking this video so far, hit that like button, hit the subscribe button if you want to get your hands on this software. Stay tuned, it's coming out to you, my viewers and subscribers. So take a look at this, folks. Jumping into the price analysis section, I'll tell you what I've done if you're new to the channel. I stayed as conservative as possible with our revenue growth numbers because I want to price out what I believe they're going to do over the next 10 years with some margin of safety. So we've seen that they've done 33% over 5 years, 24% over the 10 years, and 61% over 1 year. However, I don't want to think like that. I want to go 10, 12, and 14. Now, some may say this is too conservative, but I disagree. I want to give myself the most margin of safety as possible. That way, if they beat these numbers and they do way better than the numbers I have provided, then we are in a good position. Same thing with that profit margin. I'm giving myself somewhat of a discount, going 28, 29, and 29.5 based off what they've shown here. Same with the free cash flow margin. I brought our price to free cash flow and our PE ratio down to numbers that are more manageable beneath that 22.5 that we want to see here. So as we have 54.32 for our price to free cash flow and 45.52 for our PE ratio. So that's the discount. I'm assuming what would it look like? What would this company look like at those ratios here? Click and calculate. The software is going to calculate what we should be paying for this company today. But I'm a huge fan of Nvidia. I'm a huge fan of what they're doing, and with the growing demand of the semiconductors and that whole industry there, just primed to boom. They have a lot of runway. But now I want to see if it makes sense to get into this company at this moment. And right now, it doesn't. It doesn't, folks. Right now, our average calculation comes out to be 101.90. Now, here's the thing, folks. As I said earlier, I may have been a little bit too conservative, and I'm willing to admit that maybe that was too harsh of a route to take, doing 10, 12, and 14% revenue growth. So here's the thing. I can play with those numbers and give myself less margin of safety. However, I want to assume the worst. So this is why I like to stick with these numbers. And for me, once it gets below this 134 range here, where it has to fall, and it almost did that. It got to 140. I think if it gets down to this 130 range, which it may very well do, granted the whole scope that we are heading in towards a recession, the interest rates are rising, so these tech companies it's gonna be harder for them to borrow money. We might see the stock price fall due to that fear. However, I do think it's a solid business. Now, one may disagree with my revenue growth numbers. I'm sticking with it. But at the moment, I believe Nvidia is slightly overvalued. They're slightly overvalued based off these numerics. But it's a great company. Can't wait to own it when it eventually falls down. What are your thoughts on this company? What are your thoughts on this evaluation? Just for giggles, you know what? Let's do a higher revenue growth number. Let's go 20. Let's up it by 10 points each. So we'll click calculate. If we do 20, 22, and 24, let's just see what numbers we get here. I feel like this might make it green. And yeah, I was pretty much right. Take a look at that. Huge jumps. 243 being the average calculation. Now here's the thing, folks. If you believe 22% revenue growth over the next 10 years, given its current market cap, then this price is a price all day. And it's actually showing pretty much fair value on a conservative side at 20% revenue growth. It might be something to consider. However, I'm not thinking like that. I'm thinking in the as conservative as possible. But for me, I'm waiting for this company just to fall down in price. That's it. What are your thoughts? Write down a company stock symbol down in the comment section below of a company you want to see evaluated, and let me know what you think about this evaluation here. This is me. This is my process running the numbers, so I'm curious to hear from you. So as always, thank you so much for watching. I will see you in the next one.